Hi guys, welcome to Talking Money with Nosy, Personal Finance Made Simple. Today I'm going to be talking about monthly dividend ETFs and monthly dividend shares on the US stock market, the New York Stock Exchange. But before I dive into the list of monthly dividend ETFs and shares, I would like to remind you that dividends are not the only thing that you should look for when you are choosing your investments. Before choosing a dividend ETF or a dividend share, you need to do your research first. If it is an ETF, find out whether it's active or passive, and if it's passive, find out what index that ETF tracks. Find out what companies make up that ETF. Look at the ETF performance for the past 5 years or more. Look at the total expense ratio, which are the costs associated with managing the ETF. Remember, the less money you pay in fees, the better. Examples of monthly dividend ETFs that are available on Easy Equities are the Global X Super Dividend ETF with a dividend yield of 11.16%. The Global X Nasdaq 100 Covered Call ETF with a dividend yield of 11.92%. The JP Morgan Equity Premium Income ETF with a dividend yield of 11.76%. Personally, I don't invest in any of these monthly dividend ETFs because they don't match my investing criteria. My investing criteria when it comes to ETFs is, number one, the ETFs must be broad market ETFs. This means that I choose ETFs that cover as many shares that are on the stock market as possible. The second criteria is that the ETFs must be passive. This means that the ETFs that I choose must be index trackers. What is an index? An index is a group of companies that represent a section of the stock market. Index ETFs give greater diversification as well as lower expenses and fees compared to actively managed ETFs. The third criteria is that the ETFs should be low cost. When it comes to investing, investors get what they don't pay for. What this means is that the lower your investing fees, the better your returns in the long term. So, which ETFs do I invest in on the US market? I invest in 2 ETFs. The Vanguard Total Stock Market Index ETF, which is VTI for short, and the Schwab US Dividend Equity ETF, SCHD for short. Both SCHD and VTI pay dividends every quarter, and they are passive, low cost, and they have superior performance over the long term. Alright guys, this is the Easy Equities website. I've logged into my account, then I click on Easy Equities USD because that's where I'm going to be showing you those monthly dividend payments from the ETFs as well as the stocks. So I click on Invest Now, then select ETFs, then type Global X, then I'm going to select Global X Super Dividend, that's the one. Once this page opens, I scroll to the bottom and get to where it says Yahoo Finance, then click on that to do research. Yahoo Finance opens. The first tab that is automatically opened is the Summary tab. The Summary tab shows you, number one, the dividend yield. And guys, this is an annual dividend yield. It is not a monthly dividend yield. So to get the monthly yield, divide this number by 12. The second thing that you'll see here is the expense ratio, or the TER, total expense ratio, which is 0.58% for this ETF. Another thing that you're going to see is the inception date, which is when the ETF was launched. This was 2011 in June. Next, we click on the chart. What I like to see on the chart is the dividend distribution dates. So this is where you'll see when the dividends were paid. So I'm just going to click 2Y for 2 years because I want to see what happened in 2021. So the first dividend in 2021 was paid in February, and the amount was 7.5 US cents per ETF. The next dividend was in March for 8 cents. The next was in April for 8.8 cents. The next was in May for 8.8 cents again. Next, June, 8.8 cents. July, 8.8 cents. August, 9 cents. September, 9 cents. October, 9 cents. November, 9 cents. December, 10 cents. And another one in December the 30th for 13 US cents. So you can see that this indeed is a monthly dividend ETF. Next, what you want to see is the holdings. So I'm interested what companies are in the ETF. What are the sectors? What are the weightings of the sectors? So basically this ETF has got these sectors, the highest being real estate. So already you can see that almost half of this ETF is made of real estate shares, followed by financial services, then basic materials, which would be your mining companies. Then you can see the top 10 companies. Guys, this ETF is made of very small companies because I don't know them. I've never heard of some of these companies like Electra, China, Dongjiang, etc., etc. So these are your top 10 companies in that ETF. The next thing that you want to see is the performance. This is where it's a make or break for me when it comes to ETFs. I look at the performance. If it hasn't been doing well over the long term, maybe I should look at something else, right? So I don't look at the short term, which is your 1 month, 3 month performance. Even 3 years for me is very short term. I look starting from 5 years and 10 years. So over the past 5 years, this ETF has actually lost money. It has returned negative 4.57%. And over the last 10 years, it's also lost money with a negative return of 0.18%. So this ETF has not done anything for investors over the past 10 years. So for me, it's a pass. But anyway, before you say I'm judging too quickly, let me show you VTI, which is one of the ETFs that I invest in. So let me click on Invest Now, then select ETFs because I'm showing you an ETF. VTI is just short for Vanguard US Total Stock. The reason why I like this ETF is because it is made up of more than 4,000 American companies from all sectors on the stock market. So again, you scroll down, click on Yahoo Finance. Yahoo Finance opens with the summary tab. On the summary tab, we see dividend yield is 1.39%. Before you stop watching and say, yo, this is a waste of time, just keep watching. Next, the expense ratio, the cost of owning this ETF is only 0.03%. This is dirt cheap compared to your Global X Super Dividend, which has got a TER or an expense ratio of 0.58%. Next, the inception date for VTI is 2001 in May. We look at the chart to see the dividends, the distributions. You'll see starting in 2021, the first dividend was paid in March. That was for 67 US cents. The next dividend was in June for 67.5 US cents. The next was in September for 72.4 US cents. Next was December for 85.9 US cents. So you can see this is a quarterly distribution. They pay 4 times a year and not 12 times like the Global X. Next, what you want to see is the holdings. What companies are in the top 10? What are the sectors and what is the makeup? So here we go. Here are the sectors. The highest sector in VTI is technology, followed by healthcare, then financial services, then consumer, cyclical, etc., etc. So here are your top 10 companies, and there's no surprise that technology stocks make up most of the top 10 holdings. Apple, technology stock. Microsoft, technology. Amazon, I'd say it's a technology stock. Facebook, technology. Alphabet, which is Google, technology. Tesla, technology. The only one that's not technology is this Berkshire Hathaway. That's Warren Buffett's company, and JP Morgan and Chase. This is the largest banking corporation in America. Those two. Nvidia is also a technology stock. Next, let's look at the performance. Again, I'm not going to look at 1 month and 3 years. That's a waste of time. I look at 5 years and 10 years. So for 5 years, VTI has returned 12.61%. And over the last 10 years, it has returned 12.93%. Not bad. Not bad at all. Lastly, let me show you SCHD, which is one of my investments that I buy. And by the way, guys, I only have 2 ETFs in my US account. It's the SCHD and VTI. That's all. You don't need a lot of ETFs, guys. I promise you, you don't need a lot. Even one is fine. Like if I was to choose, if I were to really choose, I'm really pressed. I would only go for VTI. So then scroll down, click on Yahoo Finance. It opens, summary page. The yield is slightly better than the VTI yield. It's 3.1%. The expense ratio, which is the cost, also cheap, 0.06, even though it's slightly more pricey than the VTI. Inception date was 2011. If you go to the chart, again, I'm sure you get the gist. You will see the dividend distributions. It's also quarterly. So you can see in 2021, they paid in March, 50 cents. They paid in June, 54 cents. They paid in September, 58 cents. They paid in December, 62 cents. So that's a quarterly distribution. Next, you want to look at the holdings. Again, you want to see the top 10 companies and the sector weightings as well. So for SCHD, you can see that the highest sector is financial services. Then it's followed by industrials, then technology, then healthcare, etc., etc. And of course, your top 10 holdings are not going to be the same as VTI. This is a good thing. Guys, you don't want to buy ETFs that are the same or very similar. If you're going to buy multiple ETFs, make sure that they are different, that they don't have the same top 10, because that's like duplicating your investments. So you see the top 10, Merck, that's a pharmaceutical company. The Home Depot, that's a home improvement store, similar to Builders in South Africa. Texas Instruments, that's a technology stock. Broadcom, also tech. Amgen, I'm not sure. PepsiCo, it's a beverage and snack company. BlackRock is an investment company. Pfizer, pharmaceuticals. Cisco, tech. Verizon Communications is a telecoms company. So you can see that there's a mixed masala. It's different from VTI. Next is performance. Again, I look at 5-year and 10-year. So over the past 5 years, SCHD has returned 13.8%, whereas over the last 10 years, it has returned 13.68%. Not bad at all. Then lastly, a really cool tool that I want to show you is on Google Finance. You just go to Google, type in Google Finance, and it opens up this link. You click on it. What I like about Google Finance is that you can compare shares and ETFs. So let's start with VTI, and I'll show you exactly what I mean. So you click on it, then the chart will show up. This is the performance. So I like to show you long term. So 5Y is 5 years. Now, let me compare. So to compare, you select compare to. So I'll compare it to SCHD, which is the second ETF that I buy, the Schwab US Dividend Equity ETF. You click on that. It overlays the two lines, and you can see which one is doing better than the other one, right? So you can see Schwab over the past 5 years has done only slightly better than the VTI. So over the last 5 years, Schwab has grown by 60% and Vanguard has grown by 53%. Let me add Global X Super. Let me see if it picks it up. This one. So when you add it, you can see that the VTI and the SCHD are outperforming the Global X Super Dividend ETF. You can see by a mile, right? So over the last 5 years, this Global X Super Dividend ETF has actually lost 56%. But these two are up 60% and 53% respectively. So I love this tool. It's really, really cool. If you are struggling to make a choice, if you're struggling to see what makes sense, this is why I always say, don't chase dividends, because you're going to get burnt. You're going to be losing money. Chase stability, track record, and long-term growth. And for me, VTI and SCHD stay winning. When it comes to shares, the same principle applies. You don't look at dividends only. You should also look at things like revenue growth, profit growth, earnings per share growth, return on invested capital, free cash flow growth, and most importantly, you look at the dividend payout ratio. The dividend payout ratio is the ratio of the total amount of dividends paid out to investors compared to how much money a company earns. The money that is not paid out to investors is kept by the company and used to pay off debt or to reinvest in the business. The payout ratio measures how sustainable the dividend is. If a company has a very high dividend payout ratio, it is returning more money to shareholders than it should, and it will most likely end up being forced to lower the dividend or to stop paying it completely. I use a website called quickfs.net to do a quick scan of a company that I'm interested in the US stock market. All right, let me go to quickfs.net, click enter, then you can search any company that you are interested in. Unfortunately, QuickFS doesn't work for South African companies, but it works for all international companies like Australian companies, US or UK, etc. So I'm going to show you using Apple. I don't want this video to be too long, so I'll quickly go through it. I'll do a detailed video some other time. So I really love this website because it gives me key things that I like to scan for in an investment. So it shows me key statistics over 10 years. So you can see the revenue of Apple starting from 2012 right up to 2021. You can actually see the progress. They actually show you the revenue growth as a percentage as well. So you can see whether it's going up, whether it's going down. But the 10-year statistics that I look for, ROA stands for return on assets. This is just an indication of how profitable a company is in relation to its total assets. Then there is ROE, which is return on equity. It helps you to understand how efficiently a company is using its shareholders' money to generate profits. So 44% is absolutely brilliant. Then there's ROIC, which is return on invested capital. This one measures how effective a company is at turning capital from shareholders as well as debt into profits. So these numbers, if they are double digits, for me, it's good. Then you also have revenue. Obviously, revenue is your sales. Over the past 10 years, revenue for Apple has been growing at a rate of 12.9% annually. Assets, growth of 11.7%. Free cash flow, what is that? Free cash flow is the money that remains after paying for items like payroll, rent, taxes. Free cash flow is an important measurement because it shows us how efficient a company is at generating cash. So Apple is a cash machine. Free cash flow 10.8% for the past 10 years is amazing. Then you've got EPS, which is earnings per share. This is showing you how much each share of Apple brings to the company in terms of a profit. And for the last 10 years, it's 19%. Then another thing that I look at is the debt to equity. This ratio shows you the relationship of money from shareholders, which is the equity, versus debt that the company uses to finance its assets. A lower debt to equity ratio means that the company has taken on lower debt. If the debt to equity ratio is high, then the company has taken on more debt. And a company with very high debt is very risky. And a company with lower debt levels is more attractive to investors. Then lastly, I want to show you the dividend payout ratio. Where it says overview, just drop down the arrow there, click on key ratios. If you scroll down where it says dividends. So Apple has a safe dividend. Why? Because the payout ratio for 2021 was 15.2%. So it is paying out very little of its earnings to shareholders. And this also is an indication that Apple has room to increase the dividend. So even though now Apple doesn't pay a lot of money in dividends to shareholders, you can see that the dividend is safe, meaning the chances of the dividend getting cut is very slim. Also, there is a higher probability that over the coming years, so in the next 10, 20 years, etc., Apple has got a lot of room to increase dividends to shareholders. If a stock has got red flags like poor revenue growth, decreasing earnings growth, high levels of debt, poor cash flow, and a very high dividend payout ratio, I don't even think of buying it, no matter how attractive the dividend is, because I know it is a trap. Examples of monthly dividend stocks are Realty Income, symbol O, with a dividend yield of 4.23%. Stag Industrial with the symbol Stag with a dividend yield of 4.64%. AGNC Investment, symbol AGNC, with a dividend yield of 12.54%. EPR Properties with the symbol EPR with a dividend yield of 7.03%. Again, I don't invest in any of these monthly dividend shares. The reason is that they are real estate investment trusts, or REITs for short. If you remember last week's video, I said that income from REITs is taxed at your marginal tax rate. My marginal tax rate is higher than 18%. So it means for me, income from REITs wouldn't make sense because the rest of the shares on the US market are taxed at 15%. So if I can avoid high taxes, I'm going to avoid them. If I want to invest in REITs, the best way for me to do it is to buy them inside of my tax-free savings account, the TFSA, and then in that way I avoid income tax. The last thing that I'm going to say is you should have a reason why you invest in particular shares or ETFs, and your reason should match your financial goals. Let me use myself as an example. I'm still quite young and I have a very long investment timeline ahead of me. My main focus right now is not income, because guys, let's be honest, you will not get a meaningful dividend income from just a few thousand rands worth of investments. Most people who are earning meaningful dividend incomes have hundreds of thousands and even millions invested. That is why I don't care much about high dividends or monthly dividends right now. What I care about the most is capital growth. I want my money to grow. So I look for investments that will grow my money as much as possible over these many years that I'm going to be investing. Any dividends that I earn at the moment are just a bonus, and I reinvest all those dividends. I don't withdraw them at all. I'm going to start caring about high dividends and withdrawals, etc., when the time to live off my investments comes. Those who worry about income and dividends are usually people with large sums of money or people who've retired, for example. But if you're still young and you're still investing a couple of $100 there or 1,000 Rand here and there every month, look for capital growth. Long term, guys. Let's think long term. Okay guys, that's it for today's video. If you liked it, please hit the like button and subscribe to my channel. I will see you next week for another video where I'll be talking about setting up a monthly dividend portfolio using a mixture of shares and ETFs that pay dividends in different months. Until then, bye guys.